can business owners in Canada get a true pension plan? Welcome to Tea at Taxevity, where you get insights from insiders, our many clients and friends. I'm Pramod Sharma, the actuary at Taxevity. I help people who care about sustainable financial independence harness the power of life and health insurance. Our guest today is Jean-Pierre Laporte. Welcome, Jean-Pierre.
Thank you.
What do you do when you're not being interviewed?
What do? I dream about pension plans.
You dream about pension plans?
How to make them better and reform them.
Okay, because some people find that pension plans are a nightmare because they don't necessarily have one. Now, you talk about true pension plans. What do you mean by that?
I mean a pension plan that will provide you with a secure and stable source of pension benefits throughout your retirement. Not something that's a bit of a guessing game, like an RRSP, where if the stock market collapses just on the verge of you taking your retirement, you're going to end up with a lot less money to retire on than had you been in a true pension plan.
What you're describing sounds like a dream, but it would provide so much peace of mind for people to have something like that. Now, when it comes to pension planning, we know of RRSPs. Can you give us an idea of what the limits are for those?
Well, this year, the RRSP limit is $24,930.
Okay, and
so that's the most you can put in, and you would reach that particular level of contribution around $140,000 of earned income. The rule is that this Canada Revenue Agency will allow you to put 18% of your earned income into an RRSP up to that limit that I just mentioned, close to $25,000.
Okay, and are there ways to put aside more money than an RRSP will allow?
Yes, there are two main ways. One is using a defined contribution registered pension plan, and another one is using a defined benefit plan that's also a registered pension plan.
Okay, now the type of pension plan that, say, a civil servant or a teacher would have is probably a defined benefit pension plan?
I would say at least 90% of the case. If you work for the federal government, a provincial government, municipal government, and many of the parapublic institutions, you would be in a defined benefit plan. If you're a teacher, you're in a defined benefit plan. If you work for a municipality, you'd be in a defined benefit plan.
Can you give us an idea of how the limits for contributions compare?
Sure. I've got here the 2015 tax limits for the RRSP, which is the red line.
So that looks like the same amount for everybody, no matter what the age.
Once you've hit the maximum earned income, you can't put any more money. So it doesn't matter if you make $1 million or you make $140,000, you can only put $24,930 this year.
Okay.
The black line is the defined contribution registered pension plan limit, which is also known in tax jargon as the money purchase limit.
Okay, money purchase plan.
And the money purchase limit is always higher than the RRSP limit, because when you read the income tax regulations, it says that the RRSP limit is last year's money purchase limit.
Okay, so that's why the two of them are very close to one another.
They're very close, and there's a gap.
Right.
Because as the money purchase goes up, the next year the RRSP catches up.
I think I like that blue line. What is that?
Well, the blue line is the contributions that you can put in a defined benefit plan. And you can see that it's really, the x-axis is really the age of the plan member.
Okay. So
that as you get older, the actuary allows you to put more and more money into the pension plan. And the way that the laws work is that whatever the actuary determines is required for the contributions, that is what becomes tax deductible. So you can see that a young person, an 18-year-old, is penalized vis-a-vis an RRSP, the red line. So if you're really young, it would make absolutely no sense to be in a defined benefit plan if tax sheltering is what you're looking for, sorry. However, if you're an older, and the crossover point is around age 40.
Okay.
So if you are approaching retirement, you can see that you can put a lot more money, sometimes $15,000 more inside of the defined benefit plan than if you had stayed in an RRSP.
And we know that if you're able to put in more money, you'll have more money later on.
That's just mathematics. That's just arithmetic.
So why is it that an individual pension plan allows you to put in more money than the other types of plans?
Well, an individual pension plan would be a defined benefit plan that offers this type of pension to a single individual. So normally if you are above age 40 and you're inside of an individual pension plan, you would be saving on this blue line. And the rationale, and as an actuary, I'm sure you're familiar with this concept, that since the monies that are contributed to the plan won't have as many years to grow, there has to be something that gives, and therefore more contributions are required in order to meet the promise that is made by the plan. Whereas if you're very young, a contribution made 40 years before you retire will have a number of years to compound in a tax-free environment and provide the assets required to meet that promise.
With an RRSP, the contributions are tax deductible. What's the tax treatment of contributions to an individual pension plan?
It's the same. So they're tax deductible to the party who made the contribution. So if the corporation is the one that's contributing, they get a deduction from their corporate taxes. If it's the member, they get it from their personal taxes.
Okay. Are there any additional tax advantages to using an IPP?
For an IPP, yes. If you have had your company for a number of years, you can also purchase what is called past service. So you may be able to buy back a number of years in which you were working for your company, collecting a salary, but you didn't have a plan in place. So by setting up the plan, you can look back to the first day that you start collecting a salary and add those years to your total benefit and purchase it. And you purchase it with RRSP assets and with a company contribution. And of course, that company contribution is tax deductible.
Okay, so it sounds like there's a lot of flexibility, and you even get credit for not having made contributions in the past.
That's right, you're catching up.
Who's the ideal candidate for an IPP?
Well, for an IPP, because of this chart, as you can see, you'd have to be at least 40 years of age to start benefiting from the extra contributions that are permissible.
Okay, but if I'm a salaried employee, can I have one, or do I need to have my own business?
No, you have to be incorporated, and you
Okay.
have to be drawing T4 income from that employer in order to qualify. So if you're self-employed, you cannot have an IPP.
Oh.
Well, self-employed in the sense that there's no corporation in the picture. If you're a partner of a law firm and you don't act through a professional corporation, because you're not employed by anyone, you cannot have a pension plan either. However, if you incorporate your law practice, now there's an employer-employee relationship and you can set up one of these IPPs.
Okay, is incorporation a complicated process?
Not really, depending on the type of corporation. If it's a vanilla corporation that doesn't have any specific terms attached to it, at our company, Integris, we will incorporate you for $400. So it's a very quick process. It can be done within 15 minutes. However, if you're a professional and your governing body requires you to have certain terms inside of the articles of incorporation, then there's some additional costs in order to comply with all of the regulatory requirements.
Okay, now from what I understand, an IPP is what you would consider a true pension plan.
Yes.
Okay, are there drawbacks though?
Yes. Well, there are a number of drawbacks. The first problem is that, as I demonstrated on the chart, young people cannot truly benefit from them because they are penalized in terms of the tax deferral room vis-a-vis an RRSP. So that's the first problem. The second problem is that The contributions to an IPP are determined by an actuary and keep going up with age, as we saw in the chart. However, if you're a business owner and you're facing an uncertain future, it may be that in the future you won't have enough money to put into the pension plan.
Yeah, that's one of the things that is scary because as a business owner, sometimes income fluctuates. And if you have an obligation to keep putting in a certain level of funding, then what do? Collapse the plan, get in trouble with the government? It's hard to know.
Exactly, and that's why a lot of people, when they're presented with the IPP, at the last minute pull back and say, I can't predict whether I'm going to have this kind of contribution room or monies to put into the plan in the future. I may have great years, but I may have bad years. And therefore, I don't want to start something that I can't finish. And that's one of the biggest problems with the IPP. The other big problem is that it's an individualized plan. It's for one person, and therefore there are no economies of scale.
Oh, that's an interesting point, yes.
No economies of scale. So all the service providers want to get paid out of this one pension fund. You can't spread the cost over a group, which means that you can't have scale. So they become expensive, and a lot of people figure that they got to make money, a lot of money, in order to pay for the fees that you wouldn't have with an RRSP. So it becomes a cost-benefit analysis, and because of the lack of flexibility, because of the complexity, and because of the inflexibility of the way that they're funded, the client usually thinks long and hard before signing up.
I understand that you've invented a better solution called the personal pension plan. Please tell us what that's about.
Yes, well, as you could see from the chart, there is a real advantage to saving through a defined benefit plan in terms of how much money you can save. But because of all the issues that surround the individual pension plan, we decided at Integris to fix those problems and to introduce the flexibility that's required if you're a business owner and you face an uncertain future.
Okay, so what are the characteristics of do you call it a PPP?
We tend to call it a PPP to distinguish it from an IPP.
Okay, so what's different?
Well, the biggest difference is that PPP is really a combination registered pension plan that has both the IPP rules and a defined contribution component. So if you look back at the chart, if you're young, you would be saving on the defined contribution line, the black line, and when you hit the magical age of around 40, you can opt to switch to the defined benefit component of the plan and continue exceeding the RRSP limits at all ages. And if in a bad year you don't have the money to keep putting money in, you can switch back to the defined contribution component and you're back down on the black line and you can make your contribution there. So that way you can modulate and reduce your cash payments to the plan when you don't have the ability to make the payments.
Okay, that sounds like a good innovation. Where did you get the idea?
I got the idea from working in the area of pension law when I was doing secondment at a financial institution. One of the clients had a combination plan for a large pension plan. And I was fascinated by this combination structure where the member has the choice between the two types of components. And I thought to myself, well, if it works for a large pension plan, why can't we do this for a single business owner? Give the flexibility to the individual business owner.
Okay. And what does the government think of your design?
Well, they've already registered it a number of times. And at first, we got some questions as to why we thought that this structure would be useful to clients, because normally you pick one or the other. But we know that the structure gives you that flexibility that you need when you're facing an uncertain future. And so we figured that we might as well have all the bells and whistles in the plan design. I should also mention that the pension plan also has another account built into it, which is called the additional voluntary contribution sub-account.
Okay, and what is that?
Well, that account is used for employee voluntary contributions. So let's say you are saving under the defined contribution component of the plan. And under the rules for that component, all you require is a 1% of salary contribution. That's all that goes in there. So if you had extra money, maybe not as much as what a defined benefit plan would require, but you have some extra money you want to put in, you would be able to do an employee voluntary contribution that would be deposited inside of the additional voluntary contribution account. And the beauty of that account is that, first of all, it's voluntary. So it's not locked in by pension laws. So if you ever needed that money in an emergency, you'd have the ability to transfer that money out of that account back to an RRSP. So that's safety right there. The second thing is, because it's pension money, it's creditor protected, because pension laws wrap around the pension plan.
Well, that's a very good point, because there are people who are worried about their retirement assets being seized by others.
That's right. So in Ontario, a lot of people don't realize that unless your RRSP is with a life insurance company and you've got a death beneficiary on record, if it's sitting with a bank, a trust company, or a mutual fund company, that RRSP is not protected from creditors. Only in bankruptcy will you have some protection. Whereas in a pension plan, it doesn't matter whether you're bankrupt or not. You always get that protection because the pension rules wrap around the pension plan and therefore protect your assets. So by transferring your RRSPs that are not creditor protected into your PPP, into that additional voluntary contribution sub-account, you've instantly protected your monies from the claims of creditors. Plus, you can also claim all of the management expense ratio or investment management fees that normally are not tax deductible inside of an RRSP. They now become tax deductible to your company if the company pays for those management fees.
How did they become tax deductible? Is it because those fees are explicit now?
No, it's because they're paid by the company and they're a deduction or an outlay of cash from the company in the course of generating profit. So the deduction comes from section 18(1)A, or I should say paragraph 18(1)A of the Income Tax Act. So by being legally responsible for those fees and by paying them, the company, once it gets the invoice, can deduct that from its corporate income. Whereas under the Income Tax Act, RRSPs do not allow you to claim a deduction.
Okay, it looks like you've thought through pretty well everything with this design of yours. Out of curiosity, there are other people in the pension field. Why didn't someone else come up with this design earlier?
That's a great question, and I get that all the time. I think it's a combination of a number of factors. One being that I've been immersed in the area of pension reform and pension law for a long time, and I've come across a number of different plan designs. And I'm also, by virtue of being a pension lawyer, a business owner. And in that capacity, I've been able to see that there is a crossover between the world of business owners and the technical world of pensions. And a lot of people don't have this ability to have this overarching vision of the products and how they could be implemented. So for me, when I realized that this was an issue, that people in the private sector were not able to save as much as someone in the public sector, I started investigating, how can we fix that problem? And that's when I stumbled on the IPP. And then I realized that the IPP had a lot of issues with it. And so I decided to look for solutions. And discovering the combination plan structure was one part of the solution, but also thinking about the plan from a broader perspective of, this is very complicated stuff. Most people do not really get a sense of how this works. So that's part of the problem, is if you don't really understand something, you're not going to venture there. So what the PPP does is it takes all of that complexity out by asking Integris, the company, to act as the delegated plan administrator and to look after all of the complexity, the compliance, the actuarial, the legal, and other elements of the plan.
And you do have government approval for what you're doing also,
Yes.
which provides tremendous peace of mind.
Well, that's right. So it's approved by 2 levels of government, which is...
2 levels?
Yeah, because a pension plan has to be, in Ontario, for example, has to be registered not only with the Canada Revenue Agency, but also with the Financial Services Commission of Ontario. So there's really 2 levels of regulation scrutinizing the plan in order to approve it. So it's not like buying some financial product that someone might maybe peddling. And the other thing that to keep in mind is that we don't actually manage the assets. So it's not like we would be making errors and investing the funds foolishly and losing money for clients. We do not touch the assets. That is a separate piece of work that's done by the investment advisor that has been appointed by the client. We simply look at the pension plan from a compliance and structure vehicle. It's a different, so you're really getting the best of both worlds. You're getting top-notch compliance from us, and if you have a good investment advisor, top-notch investment management skill.
If someone wants to get a PPP, what's the process?
Well, we have a number of distributors, a number of financial institutions who offer the PPP on their platform. So if you deal with any of those, you would be asked to fill out a questionnaire, and the questionnaire is used to do an actuarial evaluation of what would happen to you if you upgraded from your RRSP to a PPP. And then you can ask questions about what would happen in the case of death, in the case of retirement, if I sell my business. You can figure out how this might impact your business, and then we can start enrolling you.
Okay.
Yeah.
What the PPP sounds really good, and like I've done some checking into it myself because I've got to be very careful about the guests on the show, and it looks like it's quite solid. I'm just wondering, what sort of things could go wrong?
What could go wrong? I guess the worst thing that could happen is if you set up a pension plan, but you weren't really interested in saving for retirement. You treated it more as a savings account where you stash money, get a tax deduction, and if you need it for an emergency, you just dip back into your pension fund and take the money out. We cannot assist people that treat us that way because pension laws lock in the mandatory contributions that are made to the plan. The pension rules do not permit you to withdraw that cash before a certain age. Typically age 55 is the earliest. Now there are exemptions to that, but that's the general rule. The other type of person that would be very disappointed with the PPP is someone who thinks that they are Warren Buffett and they can put all their eggs in one basket and belt the ball out of the ballpark. Because it's a pension plan, a true pension plan, we have to follow what are called the federal investment rules, which impose concentration limits. So for example, one of the limits is you're not allowed to put more than 10% of the book value of the entire pension fund in any one security. So, so there's a restriction on how many eggs you can put in one basket. So for someone who wants to put all of their RRSP assets in the stocks of a particular bank, and that's how they want to manage their money, we can't help them. So those people would be very disappointed if they set up a plan and then try to do that, because our compliance team would say, sorry, you're breaching the concentration limits.
What happens if someone gets lousy investment returns in their PPP?
Well, what happens is that every 3 years the actuary has to do a valuation if they're saving under the defined benefit component of the plan. If they're saving under the defined contribution component of the plan, they just have less assets. However, if they're saving under the defined benefit component of the plan and they lose a lot of money, when the actuary does a valuation, they will determine that the plan is now in a deficit position. And under pension law, your company, the business, will have to make what are called special payments to top up the pension fund and bring it back into balance.
Okay, so you get to put even more money in.
Yes, I guess that's the silver lining of being in a defined benefit plan is you claim more tax deductions and you're back to where you ought to be, plus you are buying assets that are depressed in value and can always sell them when they're worth more. So you get the buy low, sell high opportunity when others in the RRSPs can't do it because they've already maxed out their limits.
Isn't there a risk that the government could change the rules that affect PPPs?
Yeah, that's always a possibility, and that has happened in 2011 when the government tightened up the rules as to buying back past service.
Okay.
They made some changes to the regulations that are used to calculate how much the company could contribute to the plan in order to buy back past service. So that can happen. We've had a number of tinkering changes made over the years.
So that would affect all defined benefit plans, I gather?
Well, those particular rules were really targeted at connected person plans, so really individual pension plans.
Okay.
But if the government wanted to scrap the rule that says you can put more money in a defined benefit plan than an RRSP, it would impact all pension plans, all defined benefit pension plans.
What are the costs of setting up a PPP?
Well, we don't charge a setup fee.
Okay.
So it's really an annual administration / actuarial fee that is charged. And we have a number of platforms. So if you are on the insurance platform, so our insurance carrier is Industrial Alliance. And on the insurance platform, the actuarial fee starts at $1,200 if you have a single plan member. And if the company sponsors 2 plans, it drops to $1,100. If it's 3 plans, it's $1,000 per member. And that's it.
And those are probably tax deductible.
They are tax deductible, yeah.
I think I read something on your website saying that the cost is comparable to that of a mutual fund.
Well, if you tack on the Integris fee plus the investment management fee, because we get typically institutional pricing, you are better off than in a mutual fund as a retail customer.
Okay.
Yeah, so all in with all these extra services, you're still better off than being as a retail customer in your mutual fund RRSP.
What's your key message for the people watching today?
Well, if you're a business owner and you've been saving through an RRSP and you really want to have a true pension plan that's going to put a lot more money in your pocket and give you peace of mind and stability in retirement, you have no option. You have to upgrade to a PPP because the RRSP just doesn't cut it. It doesn't have the tax deferral room that the PPP has.
What's the best way for people to reach you?
Well, we have a website, which is www.integris-mgt.com. You can also reach us on our toll-free line, 1-855-214-5008. And you can also visit us in Toronto at our 2 offices in First Canadian Place or in Etobicoke.
Thanks very much for dropping by.
Thank you very much.
Thanks for joining us for Tea at Taxevity. The Taxevity Insurance Advisory helps you understand insurance and bridges gaps in your coverage. There's no premium for peace of mind. How healthy is your insurance?